What if I told you there's an investment account that gives you a triple tax advantage, never expires, and can essentially turn into the retirement nest egg of your dreams? Some say it's better than a 401k and IRA, Roth, or traditional. Yes, I'm talking about the Health Savings Account, or HSA for short. Follow along to make the most out of this incredible account and how to unlock your money penalty-free even decades later. So let's start from the very beginning. What exactly is an HSA? An HSA or Health Savings Account is like a hidden gem in the world of personal finance. If you are covered by a high deductible health plan, HDHP, you can open this special savings account and enjoy some of the best tax benefits out there. Here's why people call an HSA a triple tax advantage account. Contributions are tax deductible. When you put money into your HSA either by payroll at work or on your own, it lowers your taxable income. This is similar to making contributions to a 401k or IRA, both traditional. Your earnings grow tax-free. Your HSA isn't just a simple savings account. You can often invest the money in mutual funds, stocks, or other vehicles once you reach a certain balance. Any interest, dividends, or capital gains you earn on those investments are tax-free. Think of it like a Roth IRA, but even better in some ways. Withdrawals for qualified medical expenses are tax-free. Finally, when you spend this money on eligible healthcare costs, everything from prescription medication to doctor's visits, you owe zero taxes on the withdrawals. That's right, no taxes on the way out, provided you use it for qualified medical expenses or for other reasons we'll get on later on in the video. Imagine depositing $1, not paying taxes on it, watching it grow in the market without paying taxes on the gains, then using that same dollar plus any growth later on for medical expenses completely tax-free. That's the power of an HSA. Of course, you do need to meet the requirements to open one, primarily having a high deductible health plan. But if you qualify, an HSA can be the most powerful tool in your financial toolkit. In the next section, we'll look at how much you can contribute each year, what happens if your employer offers an HSA match, and why this account often gets overlooked. If you have an HSA, here's how much you contribute in 2025. $43,000 for individual coverage or $8,550 for family coverage. And if you're age 55 or older, the IRS lets you contribute an extra $1,000 each year as a catch-up contribution. Now, if your employer offers an HSA match, keep in mind that these contributions count towards the same annual limit. That's different from a 401k, where your employer match doesn't reduce how much you can personally contribute. For HSAs, everything you and your employer deposit goes into the same one bucket. So the total can't exceed $4,300 for individual or $8,550 for family in 2025. For example, if your employer contributes $500 to your individual HSA, you can only add $3,800 of your own money before hitting that $4,300 limit. Keep that in mind as you plan your contributions for the year. Now let's dive into a strategy that even seasoned savers sometimes overlook: investing your HSA funds for the long haul and paying your medical bills out of pocket. You see, many of us treat an HSA like a basic checking account. Put money in, pull it out, and whatever medical expenses bills come up are paid for. And that's fine if you need it. But if you have enough cash flow to cover your medical expenses out of pocket, consider this alternative. Pay your medical expenses with your own cash or credit card. Don't tap into your HSA right away. Keep your HSA contributions invested, whether that's in mutual funds, ETFs, or whatever investment options your HSA provider offers. Save all your receipts, every invoice, every prescription cost, because you might want to be reimbursed for your HSA in the future. More on that later. Why bother with this approach? Tax-free growth potential. By leaving your contributions in your account, you let them grow tax-free. You're essentially supercharging your HSA earning potential, similarly to how you might treat a 401k or IRA for retirement. There's no time limit on reimbursements. With an HSA, there's no deadline to reimburse yourself for qualified medical expenses as long as those expenses were incurred after you opened the account. That means if you keep track of receipts from, say, 2025, you can still take the money out in 2035, 2045, whenever you need it, and it still be tax-free because it's going towards a past medical expense. It creates a backup emergency fund. Over the years, your HSA could grow into substantial balance. If push comes to shove and you need the money, you can reimburse yourself for any past medical expenses you've been saving receipts for. It's like having a hidden stash of cash without worrying about a tax penalty. Of course, this strategy only works if you can comfortably cover your healthcare bills without tapping into your HSA. You don't want to run up high interest reduce debt just to keep your HSA untouched. But if you can swing it, letting those HSA dollars compound tax-free over the years is one of the smartest moves you can make for long-term financial health. Let's talk about who can actually open and contribute to an HSA. It's not quite as simple as just wanting one. You need to check a few boxes to qualify. First, you must be enrolled in a high deductible health plan, HDHP. You cannot be claimed as a dependent on someone else's tax return. And finally, you can't have any conflicting coverage. This could be things like non-HDHP plans, certain types of supplemental insurance, or Medicare if you're over 65. Now, what if you start your HDHP partway through the year, say in August? Here's where it gets a little tricky. Prorated contributions are a thing. Under the standard rule, you can only contribute a portion of the annual limit based on how many months you were eligible for. For example, if you're eligible from August through December, that's 5 months. You'll typically contribute 5/12 of the annual limit. There is something called the last month rule though. This is a special IRS provision that says if you're HSA eligible on December 1st and remain eligible through the entire following year through December 31st, then you're allowed to contribute the full year's limit even if you only became eligible in August. But be careful, if you use this rule and lose your HSA eligibility at any point during the following 12 months, for example, you switch to a different plan, the IRS can claw back the extra provisions plus penalties and taxes. Essentially, if you're mid-year HSA eligible and want to maximize your contributions, the last month rule can be a big help, but only if you're confident you'll stay in an HDHP plan for the required period. Now, let's talk about one of the biggest advantages of an HSA compared to similar looking accounts. Your funds never expire. Unlike a flexible spending account, FSA, which follows a use it or lose it rule, every year, the money in your health savings account rolls over indefinitely. With an FSA, you generally have to spend the money within the planned year or by the end of a grace period, or it's gone. This can lead to frantic end of the year rush to buy extra contacts or stock up on first aid supplies. With an HSA, there is no such deadline. Any funds you contribute today are yours to keep, regardless of what happens next year or even a decade later. Plus, if you're investing your HSA balance, it has the potential to grow year over year, tax-free until you need it. This means your HSA can serve as a long-term medical emergency fund, or even a healthcare nest egg in retirement, or without healthcare. See later on in the video. If you're consistently contributing and investing, you could build up a substantial balance over time. Let's go over the penalties and withdrawals for HSA accounts. For qualified medical expenses, it's any age. If you use your HSA funds for qualified medical expenses, you pay no taxes and no penalty whether you're 25, 45, or 75. It's always tax-free provided there's a legitimate medical expense. Non-medical expenses before age 65 is more annoying. If you decide to use your HSA money for non-medical expenses before turning 65, you'll face 2 hits. You owe income tax on the distribution, plus a 20% penalty on top of that. Once you're 65 or older, you can withdraw HSA funds for any purpose without that 20% penalty. However, you will owe income tax on the amount you withdraw if it's not used for qualified medical expenses. Many savvy savers treat the HSA like an extra retirement account. Some even say it's better than a 401k or IRA for medical spending because you get it tax-free in, tax-free growth, and tax-free out when used for healthcare. So there you have it. An HSA can be one of the most powerful tools in your personal finance arsenal. If you're healthy, have a high deductible plan, and can afford to pay expenses out of pocket, consider saving those medical receipts and letting your HSA ride the market. By the time you're retired, you could have a solid tax advantage reserve for healthcare costs, or even a backup source of funds for anything else after 65. If you found this video helpful, like this video, subscribe to the channel, and drop a comment below on how you're using your HSA. Thanks for watching, and I'll see you next time.